Hello. Hello. It's good afternoon, everybody. I hope you can hear my voice and also see my screen clearly. So today's webinar basically is not going to be this. We're not going to look at charts as such. We want to do a bit of talking. That is, we want to try and understand something which is very, very useful, yet it's being overlooked by almost everyone. So if you check online, basically very, very few people talk about this thing. You'll find a lot of strategies, you'll find a lot of indicators, you'll find a lot of experts, but rarely do you find people who've documented how to manage risks properly. So the reason being that most people overlook it, but it's the most important aspect of trading. Don't be deceived. This is the most important aspect of trading. If you don't know how to calculate your risk properly, if you don't know how to risk properly or to calculate your risk so that you are risking only whatever you're comfortable with, then you may likely not get it right in the forex market. So even with the best strategy, even with the most best strategy that somebody will tell you that this is a strategy which works maybe 90%, 70% at a time, there's always just 50% chance that if you enter a trade based on whichever strategy you're using, it's just 50% chance successful. So all strategies, do not be deceived that there's those that are maybe 90%, 60%. No. All strategies, almost all strategies are just 50% accurate. Because whatever, somebody may tell you that maybe you sell when the price goes below this, all of these three indicators, you sell it. When the price goes above these indicators, you buy. So that is true. You may see that if the price had gone above this point, like it did here, you took that buy, the buy went correctly. If the price goes below, you took that sell, the sell may have gone correctly. So it may look like that went successfully, but the truth is, if this happens when the price goes below this point, it's always exactly 50% chance that the price may go your way or the price may reverse to the other direction. This is why you must be very careful. So no strategy is above 50%. Don't be deceived. There may be those that take advantage of news or things like that, but even those which looks very, very good, if you check them on a longer time frame, you'll find that still they're just 50%, 49, 51%. That's still 50. So I had a guy who told me that okay. So we have two moving averages. I was using two moving averages, and those moving averages are the 3-period moving average here, simple period moving average, trend. I'll add the 3-period moving average, sorry, the 30-period simple moving average, this is it. And then I'll also add the 200-period moving average. So I give them different appearances so that you are able to distinguish between the two. So his idea was that when the 30-period moving average goes above the 200-period moving average, that's a buy. When the opposite happens, we sell. When the same happens, we buy. When the opposite happens, we sell. So when this happens, we sell. When the opposite happens, we buy. When this happens, we sell. When the opposite happens, we buy. Okay, that looked true. It looked as if we'll be winning a lot of trades. But after careful observation, that is, I now decide to create some program which will be able to back test that. That is it true that if this happens, if there's this cross, then there is 60% chance or 70% chance that we're going to be successful. Believe me, if you test this theory with an ear, that is, if you create a program which will be able to follow this, that is, when this happens it buys, when this happens it sells, you'll find that you still have just 50% chance of being successful, because no one knows that the price may cross but still fail to go up, because it's the market which decides where the price is going, not the indicator. The indicator actually follows what the price is saying. It will show you somehow, it will try to predict what the price is saying, but cannot change what the market is doing. So if the market is upwards, Your indicator may be showing you a sell. That does not mean that the indicator is wrong. So what is missing here is you have the indicator, you have the price, you don't have the proper risk management. This is why everyone is getting it wrong. You must have a proper risk management if you are to get it right in Forex. You must have a proper risk management. This is everything. This is everything. Actually, it is the proper risk management which pushes you, the strategy you have, from 40% or 50% to 51% to 52% up to 60%. It is what gives you an edge. Because, for example, you might have noticed this when you come here and then you enter and trade, whether it's a buy or a sell, there's only 50% is going to go your way or go against you. So how much you are risking to that trade is what you have control of. So this is not a question of which strategy you're using or whatever you're looking at, whatever time frame. The question is, what do you have control of? What do you have control of? The only thing you can control is how much you are risking in the account. So if you have maybe $200, $300, or maybe you have $100 or maybe $1,000 in your account or 2,000, how much you are risking is what you have control of. So while it is true that the strategy may be 60% or whichever percentage you're talking about, the only thing you can control is not the strategy. Yes, you can control the strategy, yes. The only thing you have complete control of is how much will be deducted out of your account if the price in case goes against you. That's the only thing which you have to control. If you can't control that, there is nothing you're doing. If you can't find yourself in a position of controlling how much you are risking in a given trade, then you will not get it right easily unless you're using an ear or just an indicator which is doing that for you. Does that make sense? Yes, because if you check whatever I'm saying, if you check this indicator here, the two indicators which I'm having here, it looks like they're perfect. That is, anytime there's a cross, they tend to go that direction. But I tell you, this is only true while you can see the data. If you continue to the past, you'll find that there are times when the cross happened, but nothing happened. It didn't go that direction. It didn't go as such. Look at it. Looks really good. The cross looks really good. Even at this point, it looks really, really good. Those across the price went that direction. You can see here, there was a similar cross, but the price didn't do anything. Literally, it didn't even continue up. Instead, it went down. The same thing happened here. The same thing happened somewhere here before this cross up. So you can see that there's some mixed signals here. We do have a sell here. Just check. We do have this. We do have this one here where the price didn't go up even an inch. So this is one thing which you must be able to understand properly. If you are to make it in the Forex market, then you must understand that sometimes you may enter a trade, but the trade will not go for you. So how much you are risking in that trade is the most important thing. Don't So as I was saying, risk, but this is like the only strategy that is exactly above 50%. If you understand how to control your risk properly, then you are likely to get it correct on every aspect. So don't be deceived. Don't be deceived. You may see that whenever there's a cross here, the price tends to move up. Whenever there's a cross here, the price tends to move down. Whenever there's a cross, the price tends to move up. Okay, this looks really good. It looks like everything is happening as it is, that like in the correct way. But the truth is, it is better, yes, to buy when the price goes above. To know how to exit, that's where the problem begins. So if for example you say that this strategy is 90% accurate, that's when this across the price tends to go that way. When then this across the price tends to go up. The problem is when there's this cross here and you enter buy, if you are to exit based on the same information that's based on the indicator itself, you'll find yourself exiting somewhere here. So when that happens, you shall have lost from this point to this point. And if you sum up all these losses, all the losses which you are going to have, if you sum all of them, you'll find that they are more than the profits, even though the price was moving long distance to the upper side. Like where you have a major move like this, the price moves like this one. The price moved up like this, but then it went down. If you calculate how much you earned on those long moves, on these long moves, and how much you lost on the moves which you entered but did not go your way, you'll find that you're still losing. So that leaves only one thing: how much you are risking in a trade and how much you are getting from a trade. If you know how to get that correct, then you know how to trade. Actually, knowing how to do that is like you've made it like 60%. You are 60% successful towards your career in Forex trading. So every time you know how to calculate your risk properly, every time you know how to calculate your risk the best way possible, then just know that you've made it in the Forex market. You've made it in the Forex market. That's the secret. Knowing how much to risk in a trade, then knowing when to get out when you're in money. Those are the most important aspects of trade. Don't be deceived. There is no excellent strategy. There is no guaranteed strategy, and there is no that strategy which you say if you have this then you have everything. No, unless the strategy incorporates proper risk management, that is not a strategy. So unless the strategy incorporates proper risk management, it is not a strategy. Do not follow it. Does that make sense? Okay, so I hope that makes some sense, and I want us to leave it at that point. We'll meet again next week at the same. So thank you. See you.